Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. We have a lot to cover today, so buckle up, let's get started. Well, first thing, by now you probably already saw that last week's CPI Consumer Price Index and PPI Producer Price Index both came in higher than expected. This is a really bad sign. Everyone's kind of been hoping for and wishing for this kind of evening out and this stabilization of inflation, and it just did not come to fruition. This means that the Fed's stated purpose and goal of doing everything they can to tamp down inflation is all go, 100% green light. They're going to do everything they have to in order to tamp down inflation. Now, the bad side of that means it kind of doesn't matter at this point what gets squashed in the process. It's kind of like a steamroller making a defined direction down the road. It's just going down the road, and whatever is in its way is in its way. Their objective of squashing inflation is their highest priority right now, and even though they're doing everything in their darndest that they can to try to quell it, it is just not yet working. It's not taking effect in the marketplace yet, in the economy. That means that we have some uncertainty coming up ahead. Now, it's not all bad news all the time, but we do have to at least admit that what we're seeing is not going to be helpful in the short term. Now, we've been talking about this over the course of the last several weeks, that eventually the Fed's going to have to take corrective action because they're kind of late to the party on solving this issue, which means they're going to have to go super hard at it for however long, they don't even know. And then at some point they're gonna go, oh, well, we went too far for too long and now we need to pull that back. And they may even have to do quantitative easing again, which means that they're getting involved in the markets, thus making money cheaper to borrow and lend out so that our system is not as sick as it is right now. Will that be in 6 months, 9 months, 12 months? I don't yet know, because they're not seeing the things that they're telling us they need to see in order to reevaluate their position on how hard they have to fight inflation. So this morning we wake up to the news of the homebuilder sentiment falling by its most precipitous drop in its 37-year recorded history. There is one exception, April of 2020, when the pandemic was like right upon us and everyone was trying to figure out how everything was going to work. It had its most precipitous drop, actually, I should qualify that. Aside from that, in the 37-year recorded history of homebuilder sentiment, this month's reading is the most precipitous decline on record. That means that even ever since the mid-80s all the way through now, 90s, Middle East stuff going on, dot-com bust, the 08-09 financial collapse, all of that even, this month's drop in homebuilder sentiment is the worst among even all those historical times that we've faced. So we had the homebuilder sentiment drop from 67 to 55, which is a 12-point drop. That is a really big deal, because even though we're above 50, that's kind of like the water line. Anything above 50 is considered positive, but a drop from 67 to 55 is really big. That's an almost 20% drop in homebuilder sentiment that just happened in the last 30 days. Now, a lot of this, of course, has to do with multiple layers of factors. Part of it is supply chain, part of it is interest rates, part of it is inventory, and homebuilders, of course, are weighing what is good for them or bad for them in proceeding to build new homes to sell to people at higher rates. So there's this issue and this tension that right now doesn't look like it's creating a lot of positivity and optimism for homebuilders. Now, we'll see what other effects and impacts the monetary policy the Fed is having in upcoming readings this week and next week. First, you have existing home sales coming out this week. That's going to give us kind of a glimpse of what actual home sales have been for existing homes, not new build homes. That's going to give us a little bit of an insight. The next thing is we're going to get an insight on flash PMI this week. That's more of an economic reading as far as what a manufacturing industry looks like. That's going to help us get some insight as well. We're going to get another unemployment reading next week, of course, which will tell us how the jobs market is shaping up. And then finally, by the time we get to next Wednesday, the 27th, we're going to actually see the Fed's decision on what their short-term interest rate hike is going to be. Now, we've been talking about it being 0.75%, which is 75 basis points for weeks now. There's a 100% sentiment amongst everyone surveyed that it's going to be 75 basis points. There are some people calling for an even higher rate hike, but I'm not sure that that's going to happen. There's a chance that an entire percent, which is 100 basis points, there's a chance that that could happen at the announcement next Wednesday, July 27th, especially given the most recent CPI and PPI readings being hotter than expected. It is possible that we see that kind of rate hike. Now, on the charts and in the bond market, where mortgage money comes from, mortgage-backed securities, though we've been in this range where, depending on the loan type and the loan size, we've seen about 0.25% to 0.3%, up and down move in this kind of range for several weeks. Most of the month of July has kind of been stuck there. And then now we got the CPI reading, the PPI reading, you have the home builder sentiment coming out, you're gonna have existing home sales number come out. I think we're at this pinnacle moment where this decision we've been talking about waiting for, where the Fed comes out next week and says whether it's going to be 75 basis points or 100, this is going to be a big deal. This is going to be a big deal to the market because when the bonds are stuck in a range and they're just kind of bouncing around, they're going to break out somewhere. They're going to break out and go up, or they're going to break out and go down. But unfortunately, the sentiment is that they're probably going to continue going up because the Fed has underpinned all this decision making, saying we've got to fight inflation, we've got to do everything possible to make that happen. And if that means that's overriding everything else, then that means that mortgage rates, that means house prices, that means jobs, that means manufacturing, all these things are going to become, I'll say, like a victim, like a sidecar on the main motorcycle. They're gonna be like a sidecar to whatever their decision-making policy is gonna be. And I think that makes next week's decision a really big one. When we look back at this moment in time, 2 years from now, 5 years from now, we're gonna go, wow, that July reading, July of 2022 was an important day and a big deal. So those of you who are looking to buy a house still, you're in the market. If you have not yet had your mortgage scenario rerun in the last 90 days from when you were qualified, maybe back in January, February, or March of this year, this is the perfect time to dust off that paperwork, figure out where you're at in the market right now, how you're positioned, and what you need to do to put yourself in the right spot to still buy a house today. For those of you who may need to discuss doing a refinance because you need to do some cash out, you need to kind of attack some of the things that are kind of creating some uncertainty in your life financially, let us know. We're having quite a bit of conversations over here at the office with people doing debt consolidation. They're stacking some cash for a rainy day. People that have 30, 40% equity in their house are trying to put some of that equity to work for their own financial benefit right now, but also over the next course of at least the next 2 years, maybe as many as 5 years of their financial life, to prepare for what's happening now and what is going to happen until this all gets settled out. So if you're in a position right now where maybe you don't know if there's a solution for you in the market, let us know. There might be situations that we've already worked on that are a reflection and an exact match for what you're facing, and we can help you with. So it costs you nothing to ask, but it might cost you thousands by not asking. So please send us a direct message, send us a comment, reach your loan officer, let us know what your situation is, and we can tell you how we can help you out. As always, please feel free to share this video with your family, friends, neighbors, people that need to know what's going on in the general marketplace and how that affects mortgage and real estate. It's really important right now that we're talking with one another, we're talking to each other candidly, and we're having these conversations. We cannot avoid what's actually happening because it's inconvenient or it's uncomfortable. We need to talk about these things. So please share this, let them know we can help out, and let's get to work. Thank you so much for watching. We'll see you again next week.